Do you want to know what a perfect scenario looks like when buying a business? What makes a business so irresistible that the lender has no choice but to say yes to your deal? Well, in today's video, we're going to look at what the anatomy of a perfect business is when you're looking to buy a business. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy or sell a profitable business. If you are a small business owner looking to scale your wealth by buying an already profitable business instead of starting another one, or if you are a W-2 executive looking to get out of the rat race and doing so by purchasing a profitable business, then you're in the right place, and I'm going to encourage you to subscribe to my channel. Don't forget to hit the bell, and you'll be notified every Thursday when a new video comes out. Hey guys, I'm very excited to go over this today in this video because I think this is, if you really understand this concept, it's really going to help you a lot understand at a global level what a lender is looking like. This video is for you if you're looking to buy a business with a minimum down payment and get a loan for the difference, particularly from an SBA lender. So I'm going to tell you today what an SBA lender looks for when they're looking at a deal for you to acquire. So let's walk through that. And as I'm talking through this, I want you to think about risk. All a lender is trying to do is minimize their risk in this deal. The last thing that they want is for you to default on a payment on a $4 million loan and have them go after you because you haven't paid it. So think about what we can do, what you can do, and what anybody that works for you can do to minimize the risk on an acquisition so you can have this as a slam dunk kind of situation that the bank would be excited about. All right, with that, let's start with the buyer. The buyer is you. You are here and all of this belongs to you. So if I'm an SBA lender, I'm going to be looking at you and I'm going to be looking at your credit worthiness. I'm going to be looking at how you're able to take care of your debt and how you're able to pay your vendors. And that is represented primarily by your FICO, your combined credit score of all the three credit bureaus. They're going to be looking at your credit, and what it's going to tell them is the character, the kind of character you have. And one single number, if you have a 740, without looking at anything else, tells me or tells the bank that you're a very good steward of your bills, a very good steward of your credit. The higher the credit score, the better it is. So a bank is not going to be wanting to extend the loan to anybody less than 650. So if you are north of 650, primarily I like my buyers to be around 700 and above, because during the process of underwriting, your credit may drop. So the higher, the better. Your net worth is number 2 right here. We're looking at your net worth. The short answer, the higher, the better. Now, if you are a buyer with great credit, you may even have the down payment, the entire down payment. You may even have the management experience. But if you don't have the net worth, bank is going to look for a way to collateralize the deal. So your net worth is the difference between your assets, the stuff that you own, including your real estate, which we'll talk about in a bit, and what you owe to your creditors, and the difference is your net worth. Say if you have $1 million worth of assets, including your real estate, and you have $500,000 that you own against those assets, the difference is going to be $500,000 worth of net worth. The higher, the better. But it's very hard for you to get financed and be represented as a buyer if you don't have an established net worth. Now, one of the forms that you're going to be having to be presented to an SBA lender is going to be Form 413, which is your personal financial statement that is going to go into great detail about the kind of net worth that you have. The higher, the better. Then your management experience. And that is evidenced by your resume. If you have great experience, think about it this way, risk mitigation. If you are somebody who has been managing a restaurant chain and are the general manager of a very well-known franchise, 20 years of experience, you manage large P&Ls, you hire and fire people, you know how to grow, you grew the profit and loss, and you grew your region by tenfold over a 20-year period, you have the management experience. Then you want to take that management experience and restaurant manage and want to buy a restaurant. Do you see how that would make sense? It's about reducing risk. Your management experience is very important, but not just you. The larger the deal, the larger the management experience, not just you, but anybody who's going to own 20% or more in the deal. And anybody who's going to own 20% or more on this target business you're going to buy is going to require to personally guarantee it. So if you are 51% as the main borrower, the other ones, anybody who owns 20% or more will have to personally guarantee it, will have to submit a Form 413 for the personal financial statement. Now, down payment. Now, does the down payment need to come from you alone? Not necessarily. You can actually have zero down payment and have a bunch of investors that are going to be co-signing with you on this deal come up with the down payment. You don't necessarily have to have the down payment, but if you don't have the down payment and you don't have the net worth, then that's a different issue. So it always is a combination of them. There's no exact science. What we want both sides right here. In order for you to be able to get there, it's going to be at the intersection of having a great buyer and a great target business and collateral. So now, this is something that has come up really post-COVID, the global debt service coverage ratio, which is, now we're going to talk about the business debt service coverage ratio in a minute, but the global debt service coverage ratio has to do with you plus the business you're trying to acquire, which is the sum of the basically the net income of the business plus your net income divided by the debt service of the business and your debt service, everything that you own. So it's really represented by a formula. Net operating income plus personal income divided into business debt service plus personal debt service. The global DSCR. Now here is, what should your minimum be? Probably you should be looking at 1.25 or better. 1.25, meaning that you're going to have at least 25% more global income than you do global debt service. Now, some banks, as the credit system is tightening up, and I'll probably will be doing a video about what happens with these runaway interest rates as they keep climbing. So some banks are going from 1.25 to 1.50. I know some reputable top 10 SBA lenders that have increased from 1.25 to 1.5 and above, because that's a way, the larger the distance between your net income and the debt, the higher the cushions should something go wrong. And remember, you're buying a business that essentially is a very fragile ecosystem that is basically, you're buying a cash flow stream. So with that talks about the buyer. If you check yourself against all of these criteria, your credit, your net worth, your management experience, the down payment, and the global debt service coverage ratio. But you're not going to know the global debt service coverage ratio until we talk about the business debt service coverage ratio. So let's talk about the target business. So I actually have done 2 videos. I want you to watch them. The links to those are going to be up here in the video section. They're going to be in the comment section on the description of this video. I'm sorry. One is called How Do You Evaluate Businesses for Sale? How do we structure for maximum cash flow? And the other one is How do you evaluate businesses for sale in general? And one of them is a 34-minute video, and I go in great detail analyzing the cash flow of 3 businesses for sale right out of Biz Buy Sell. And the other one is taking one specifically case study that I've done. So you have here 1 hour worth of cash flow analysis on target businesses. So the target businesses is, again, you want to minimize the risk. So what would make sense, right, in this ideal scenario is that you're looking at businesses for sale that are according to your management experience, that you can take and run with it and be very successful at it, because you're not going to need any outside knowledge. You already have all the knowledge. So first thing we're going to look at is the business debt service coverage ratio. Essentially is the net income of the business divided into the proposed debt service, meaning your principal and interest payments. Hey, I need a favor. If this video is resonating with you, please like and comment. Comment is like the currency of YouTube algorithm. The more you comment on my videos, the more it takes this content and serves it out to other like-minded people like yourself. And I want to build my channel, so your endorsement, your liking and comment on this video is really helpful to me, and I would really appreciate it. If you have any questions as well, please put them down in the comment section. I respond to all the comments within 24 hours. So thank you so much for helping me with that. Annualized. So we're taking this straight, so the business, we're gonna take the business net income straight out of the tax returns. So what any lender is gonna look, they wanna look back in the last 3 years worth of business tax returns. Now your interim financials or now your internally generated financials, they're gonna be looking at, the lender is gonna be looking at your tax returns for the acquired business to make sure that everything makes sense, and then work backwards to see how they compare to the internally generated financial statements. So we're gonna take that, say you're looking to buy a business, let's just throw some numbers here. Say that the business is 5 million purchase price, okay? Forget about how we came up with this number or what type of valuation that is, but it's a 5 million business purchase, of which you're gonna come up with, you're looking at 500,000 down, so this is gonna be a $4.5 million loan. Follow me so far? So this loan, if there is no real estate involved in this transaction, it is purely the business and the cash flow, it's gonna be amortized over 10 years. And right now, the interest rates are increasing. Prime was used to be 5.25, then 5.75, now it's 6.25, plus there is a index rate in addition to, so you're looking at loans anywhere right now in 2022 is an environment anywhere from 7.25 to 9 and beyond. So this is going to be very important because the higher the interest rate, the higher the monthly payments. So you're going to take that 4.5 million and you're going to amortize it over 10 years at whatever rate is agreed upon, and a 7A loan is a variable rate loan. Although some banks I'm seeing they're looking at, they're making the 7A fixed if it is not tied to the prime rate and instead is tied to something else like a treasury rate. Business debts, cash flow is everything. Cash flow is king. So if the capacity, so this right here is capacity, okay? Here, the key word that you have to understand, it's credit, right? The 3 C's. You got your credit, your capacity, and you got your collateral, right? So this how they all tie in. So your business debt service coverage ratio has to be at least 1.25. I'll say even 1.5 plus. The higher, the better. The industry. There are some industries that are favored by the SBA over others. So you want to be wise and you want to be looking long before you apply for an SBA loan, preferably through your business broker, that you have in an industry that is very friendly, that the SBA is friendly towards, that they like the performance of it, they like the industry, they lend in that industry, because there are some lenders that do not lend in certain industries. Cash-rich businesses, where there's a lot of cash transactions, a lot of SBA lenders don't like because it's hard to keep track of the cash. And is most likely not reported in the tax returns, which would affect the ability to calculate the net income. So then you got your industry, then you got your growth milestones. Now, if you're a buyer, and if I'm advising you, I'm going to be wanting to see a history of growth, right? And the ideal time for a seller to sell is when it's going into an upswing. The business has grown. The business has grown steadily at a very nice rate. And it's grown, right, to the point that it looks like it's going to continue to grow. And you're buying somewhere here. You're buying where it's not the tax price, but you're buying at a time when there is some synergies that you can bring in with your management experience that can help take the business from where it is to a much bigger revenue, to a higher plateau, that you can take this as a platform company and do great things with it. So the growth milestones are very important. I don't like to see businesses that have either flattened or going backwards. You want to see a business that is consistently experiencing growth, a nice upward trend. Not crazy, but a nice upward trend, because the faster a business grows, the more strain puts on cash, which we talk about. Now let's talk about the business assets, working capital. Business assets, what is inside the business? What is the balance sheet? What are you actually buying? If you're actually doing an asset purchase, you're buying the assets of the business. What are the assets? This is this type of business that has inventory. which is one of the largest things in the balance sheet. How much cash in the bank? Are you buying are you buying the cash that is in the business? It's a part of the transaction. Because one very important thing you need to know is that working capital in a target business is very important. Every business industry will have a target working capital, which is the difference between your current assets, which is the stuff that stuff that is cash or readily convertible to cash, like accounts receivables, right? So you got AR, cash, inventory, anything that can be readily converted to cash within 1 year, that's a current asset. Against your current liabilities, anything that is owed within the 12. The difference between the two is your working capital. The higher, the better. How healthy is the working capital, and how much is that going to be negotiated? Because the working capital needs to stay in the business for you to run the business. That's part of the business transaction, which we help you analyze as if we're representing you, if I'm a business broker representing you as a buyer, I want to make sure that all of this makes sense. Again, back to the original point that I made, it has to make sense in terms of risk. The lesser the risk, the better. So far, so good. Then you got your debt to equity. Is this business, so if you're buying the assets, you're not going to buy the liabilities. The debt to equity only plays a role if you're doing a stock sale. So you're actually buying the legal entity, and sometimes you may actually have to buy the stock, the legal entity, because it's tied to licenses that would take you years to come by. So questions to be decided. But if this is not a stock sale, then the debt to equity ratio may not matter much, because the owner will actually take that liability, because they're going to be selling you the business, going to take a liability that doesn't longer belong to you. So that's the capacity. So the capacity is the ability for the business. So when the bank is measuring the capacity for you to pass that test, they're going to take the debt service coverage ratio from the business, add it to your personal debt service coverage ratio, which is going to give you your global debt service coverage ratio. Okay, so this is how it all ties together. Now, let's say you are a great buyer, but you're a little weak on your net worth. So let's say that this is an issue. Okay, net worth is an issue, and nobody's going to step up to the plate to kind of help you mitigate the net worth gap that you have, because you may not have any real estate, which is collateral. Now, I should say that, speaking of collateral, which is our third component here, is that banks are mandated to pick up as much collateral as they have. Why? Because the SBA, it's not a lender, it's an insurance policy. You, the buyer, will pay a guarantee fee that will actually give the comfort. And probably the reason why you'll be getting a loan of such low down payment, which is 10% on most occasions, is because the SBA will guarantee the loan. So if you default, the SBA will make up the gap, but they will not make up the gap if you default on the loan if the lender has not done a very good job picking up as much collateral as I can. So again, what they look for, they want a well-rounded, successful buyer. They want a great buyer with a lot of experience, great credit, and a great net worth, which means if you have a high net worth, say you have net worth in excess of $500,000, chances are that most of the net worth is coming from your real estate holdings. So if you have a house or a rental property and you bought a few years ago, you probably rode the wave on equity. So if you bought it for $300,000 and it's worth $600,000, well, the difference is adding to $300,000 that is added to your net worth. They're closely tied. It's almost impossible right now to get an SBA loan to purchase a business if you don't own real estate. So keep that in mind. Personal assets. Or say you don't own real estate, but you have personal assets that are worth a lot. You may have stock, stock on companies. You may have works of art or anything that has value. You may have businesses, under personal assets could be other businesses. Businesses, stock, okay? Art. So any of that can enhance, which will be evidenced by your statement of net worth, which is Form 413. So do you see how this whole thing kind of is tied together? So what makes what makes a bank say, absolutely, I want to know this deal. And they'll know very quickly. You have a very successful buyer that basically is a zero risk situation with the lender, with a very successful business with great cash flow, with great tax returns, smooth year-over-year growth, solid balance sheet, strong documented record of growth and not cutting any corners, with great systems and procedures. Everything is fully documented. You can take it and you can run with it. You don't have to reinvent the wheel. Everything is fully documented. Every process is accounted for. You have great staff. Oh, I forgot to say, business assets, the staff, the employees, the human assets that are coming with this business are going to be key, and that'll come in due diligence. Okay? So if you have a great buyer with a great business with decent collateral, chances are you're going to have a yes, and you're going to be able to acquire that dream cash flow business for yourself. Hope this video was helpful to you guys. For a limited time, I'm giving away my cash flow calculator, the very tool that we talked about today in today's video when we're calculating debt service coverage ratio and post debt service cash flow. It's a great little tool. It's easy to use. It's in Excel. If you want it, it's yours to keep. All you have to do is click on the link below. Thank you so much. I hope you enjoy it.